Our headline today comes to us from the Wall Street Journal and our good friend Veronica Dagger. Veronica's been on this show. Veronica writes, as mortgage rates rise, home sellers fear time is running out to cash in, OG. People worried that, you know what, mortgage rates are going to make these low prices a little bit more impossible. She says blood pressure is now rising along with home prices and mortgage rates as homeowners fear missing out on the right moment to stake the for sale sign in the front yard. The mood among sellers seems to have shifted in recent weeks from apathy about the slow boil of higher rates to urgency. Financial advisors and real estate agents said sellers are seeking advice on how best to time the market and tame their anxiety. Are you kidding me? Timing the market? I think the thing to do here, tell me if I'm wrong, I think the thing to do is go. Do it. Do it now. Do it quick.
What's the line for Star Wars? Try not, do or do not. There is no try. I think it's a little bit of alarmist. I think a smidge, right? I mean, if you're a real estate agent, what's your job? To kind of sort of get listings, right?
Quick.
Don't let them, kick the can down the road a little bit. So, you want to put some anxiety out there. You want to put some fear into the sales process and say, I don't know, man, interest rates are going up. That's true. By the way, interest rates are going up. Does it affect affordability? A little bit. Sure does. I mean, if it goes to 5 or 7%, it sure will. Does it at 4? I mean, I think we have to look back more over a longer period of time than just the last 18 months. Say, yeah, but no, they were at 2.2 like last Christmas. It's like, right. I know that, but that was ridiculous. That was manufactured, right? The numbers before that were in the 3s and 4s, which, by the way, are also insanely good. Ask your parents what their interest rates on their house was. Joe, your first house interest rate on your house was not 3 or 4 or 5.
I think it was 7.5.
Yeah.
I love how he transitioned from ask your parents to, Joe, what was your first interest rate?
If you wouldn't cut me off, I had a sequence, a timeline, what I was going to say to kind of illustrate the point, but now it's ruined. Thank you very much. My point was, Joe bought his first house at 7. I bought my house at 6. You refinanced at 5, so on and so forth. This is still historically really good interest rates. And it's fantastic to borrow money at this rate if you want to borrow money or not. It's also okay to pay off all your bills and not owe anybody any money because that's cool too.
Yeah. Well, let me run a scenario by you. Let's say that in my financial plan, a year and a half from now, let's say 18 months from now, that's a good timeline. You had planned that 18 months from now, you want to sell your house. And you're seeing interest rates going up. You're seeing that houses are maybe taking a smidge longer to sell than they were before. Do you accelerate that timeline and sell now?
Yeah, I mean, I think it really depends. It's market dependent. Is there a little bit more days on market than there were some 6 months ago? I'm not sure. It really depends on where you are. I have a client who bought a house in California and it sold for many dollars, much dollar,
much B dollar.
It sold for a ton over asking because it's hotter than the hinges of where. So I think it's really market dependent. So maybe is that a good enough answer? Maybe you should do that. It depends. I would also say on what's the alternative. If 18 months is like just it'd be nice if in 18 months I was going to sell my house and we were going to retire, but if the economy's crappy or the market's down a whole bunch, you might not retire anyway at that time. So if it's not a hard and fast timeline, I don't know why you'd really stress it right now.
It's funny because a lot of this also seems colloquial, right? We look at what should happen versus what is happening. Colloquially, we think that, hey, I hear these stories about interest rates go up and this is the way that this stuff works. So we should see demand diminish. But so far, Veronica writes, home buyer demand seems resilient. And in a further boon to sellers, the inventory of homes on the market remains low. Sellers may want to act quickly, given that, as the Federal Reserve Bank of Dallas put it, quote, there's growing concern that U.S. house prices are again becoming unhinged from fundamentals.
This is also the group that 8 months ago was like, inflation's not really a thing. So
Inflation not happening.
nah, yeah. The vice chairman for the Federal Reserve's like, it's okay. It's not a thing. Don't sweat it. And now they're, dropping
Sweating it. Now they're sweating
a
it.
knowledge bomb of, well, maybe it's not great. I saw an interesting piece the other day on Twitter, and I feel like it was from one of the folks from Ritholtz. Of course, we just had, one of their top guys, Nick, Monday on the show. I don't think he posted about this, but it was the historical returns of real estate at different levels. Like, interest rates were at this, and what did housing prices do? Interest rates, they're all positive. Housing prices still go up. They just don't double. Like, everybody's used to this. Yeah, my house was worth $500,000 and now I can sell it for $1 million. I just have to get that to happen twice more and I'm out of here.
That's all I got to do.
It's like, okay, that's not
going to
normal.
be another 3 years, just 3 years.
Yeah, and 3 years from now, I can sell this baby for $5.8 million, and I got my fire. I'm fired out. It's not normal. And unless you're going to move to an apartment, which also carries with it higher costs today because of inflation, you're going to just buy back into the same market. So I don't think it's as big of a deal as everybody thinks. It's going to affect the second houses. Absolutely. The people who have excess cash that are thinking about, like, how do I get my lake house? You can do that. You can stretch that a little bit more when you have low interest rates and a good economy and so on and so forth. If those things start drying up, that's where the impact will happen, in my humblest of opinions.
Well, Veronica Dagger completely agrees with you. And she writes that because people look at real estate nationally, they think about this incorrectly. The first thing to do is to look in your backyard, where you plan to sell, where you plan to buy, and see what's going on there, because it's a piece by piece situation. But regardless, if you are, or is it irregardless? Is it irregardless?
Yes.
Yeah. Yes, irregardlessness. The big question is, if you're new to this whole lending landscape, let's talk about exactly what questions you should ask. And a great site called consumeradvocate.org, consumer protection site, has some questions that you should ask whenever you get a loan. And I thought we'd walk through these. Number one, what type of loans do you offer and what are the qualifying guidelines for each? So there's fixed rate, adjustable rate, FHA, and a Veterans Association loan. We don't have to do the 201 on these. We'll save that for our newsletter, OG, but just a very quick difference between fixed, adjustable, FHA, and a Veterans Association loan?
Well, I mean, some of them overlap, right? You can have a VA loan that's fixed and FHA loan that's fixed. It just kind of matters what your qualifications are. If you're showing up to the bank with exactly 3.01% down, and it's your first home and you have very little credit established and not a lot of down payment or income, you might be in the FHA. If you're a veteran, obviously look at the VA. If you're what we would call a conventional lender or conventional borrower, you look at more of a fixed or variable. If you think interest rates are going to go down, you should get a variable one. That would be a bold move.
Right now.
I mean, like, if you want to say,
be a pretty damn big optimist, I think.
If you want to walk into the bank and be like, I'm going to take one of them variable rate mortgages, the banker will be like, yes, you will, sir.
It's like what do they call it? They don't call it Fast Pass at Disney anymore. It's like the lightning lane. They're like, oh, there's a line of 50 people in the fixed rate one. You get to go to the front if you want. You want a variable loan?
Cha-ching.
Yes,
we'll take it. So I don't know that you'll see a lot of those. And then within those categories, it depends on the amount that you're borrowing. If you're trying to borrow a normal amount, a couple $100,000, then you're a regular borrower. If it gets above whatever the number is in your county, it's different, but it's, 600,000 or 700,000, then you have a jumbo loan, which is a whole different thing altogether. So lots of different ways to cut that up.
And brings up their second question. What is the interest rate and the annual percentage rate? And the difference between those, the rate is the rate. That is what you're going to pay. And that's going to be based on the size of the loan. Once again, a jumbo is going to have a higher interest rate than normal loan. And that's going to be based on your credit score. So you want to pull your credit score ahead of time and see if there's some quick things you can do to maybe clean up your credit. And that will drive down your interest rate maybe a little bit. But the APR is important, OG, because it not only is the interest rate, but that also includes all the fees. This is what the rate is if we include all the fees, all the extra charges that are going to get thrown in.
Yeah, I mean, obviously there's cost to do business. There's cost to borrow money. Bankers got to get paid. The mortgage guys got to get paid, so on and so forth. So you want to know what those costs are. Sure.
Well, and that is a key, and this skips down to number 6. APR is going to include those fees. So what cost are you going to have? And then look up which one of those are negotiable. Are there negotiable fees? Can you estimate and explain what those fees are, as well as how much you're going to make off of the loan? Another big one, by the way, is there going to be a prepayment penalty? And we rarely see this, OG, but some of these lenders, a little shady. And if there's a prepayment penalty, I think I would try as hard as I can to walk away from that one.
Yeah, never in a million years. I mean, not in today's day and age.
Next question, how large of a deposit do you need? There's a thing called PMI, which is mortgage insurance. You would think that private mortgage insurance protects you. It's not made to protect you. It's made to protect the bank. That's insurance that the bank gets because you didn't put much money down.
Yeah, I mean, PMI is basically the worst thing imaginable. So if you can figure out a way around it, up to and including just don't buy that house, it will be better off, because it's very hard to get rid of. The mortgage people will tell you it's the easiest thing. Oh, as soon as you hit this number, then magically it goes away. It's not. You have to apply to have it go away. It's never
pay for a new appraisal.
Yeah, you got to have a new appraisal done. And who hires the appraiser, by the way?
Yeah, not you.
Not you. The guy who's collecting the premium, the guy who's collecting the insurance money from you, is the one that goes, why don't we have Bill go out there and tell us, oh, snap. It's just
so close.
Maybe in another year and a half it'll be there. Yeah, figure out a way around PMI. Do 2 loans, buy a smaller house, make a bigger down payment. Just don't have PMI.
Notice that later on, we're bringing up the next question, which is what's the monthly payment going to be? This is where most people start. You don't want to start with monthly payment. Ask all these other questions first, and then get to the payment. Of course, make sure that fits in with your overall plan. And then, do you offer loan rate locks? And right now, I think OG might be a decent time if you're looking and you're not sure what you're going to buy, to maybe lock in a rate.
Yeah, a little bit. I mean, mortgages are such a commodity now that, you can kind of go down the path with your local banker and then start shopping that. You know what I mean? Get your pre-approval done so you kind of know where you're supposed to be looking. Don't walk in, if the bank says you're approved for $400,000, don't go walk into a $500,000 house. I will spoil the ending for you. They're generally nicer. $800,000 houses are bigger. They have cooler stuff inside than $400,000 houses. Don't walk into one, because you'll say, I really want this. I didn't know they put crown molding on ceilings. It looks nice. Yes, it does. It's very nice, but you don't need it if you're approved for $400K. So it gives you a sense of where you should be shopping. And then as you kind of move down the path, then you can take the transaction and say, how do I optimize this transaction? So kind of take it a step at a time.
Deeper into this, what are mortgage or discount points and how do they affect your loan? If you're going to be in a house a long time, paying some points up front will increase your cost, but could drive that interest rate through the floor. Yep. Where you never have to think about refinancing again. What are the closing costs? How much will mine be? What is escrow? I love some of these questions. We will link to this, by the way, not just in the show notes, but we'll do a deeper dive in our 201, our newsletter, where we do a deeper dive into all the topics we talk about. StackyBenjamins.com/201, the number 201 gets you signed up for that. Of course, it's always free. And if you're not finding value in it, you can always unsubscribe, but we aim to please with the 201. Good stuff there, OG. I think our takeaway is, though, start with your debt strategy. I wouldn't start off with, oh my goodness, interest rates going up, I got to lock stuff in. Start off with what's my strategy and get it done. I mean, how long have we been warning people that at some point interest rates are going to go up? So get your risk management strategy put together.
Mm-hmm. Yeah. Yep. Or just pay it off and not owe anybody any money. That's also a good strategy.
So good. Freedom from worry.